Okay, let's start. Hello, everybody. Welcome to this Learn to Trade webinar. And we're going to be looking at best stocks to buy in March 2021. My name is Gary McFarlane, and I'm an analyst and editor at Ishares, the sister website of Learn to Trade. And I was formerly the cryptocurrency analyst at Interactive Investor, which is the UK's second largest stockbroker. And but today we're going to be talking about stocks. I haven't got any crypto to suggest. I assume you're all in Cardano already, which is listing on Coinbase today, I believe, Coinbase Pro. But anyway, that's another story. Let's get started because we don't have much time. And the three tips we have for today are Halfords, Eurofin Scientific, and the Russell 2000, the exchange traded fund from Ishares. Okay, let's begin with Halfords. I'm going to be sharing my screen every now and again. And for those of you not in the UK, it may not be that familiar a company or brand even. And Halfords is in the cycle and auto space where they provide retail and services. So they have some garages also. They have an auto center segment. And as I say, they have a retail operation where they sell accessories and parts and so forth for auto, but also they sell cycles, mechanical bicycles, but also importantly, they also sell e-scooters and e-bikes, which is a rapidly growing marketplace, certainly in the UK. And I think that is the case around most developed economies and some emerging economies for that matter. So the EV space is hot, and Halfords is homing in on that area. Now, let's just have a quick look at Stockopedia. I'll share my screen so you can see what's happening here. Give me a moment. Okay, and here we have Halfords down 0.52% today. Let's look at some of the major stats of the company. I think here we see the PE ratio is 13.7, the forecast. And I think the TTM, the trailing 12 month, is around 16. And that is the kind of area where you would locate value stocks. And I would argue that Halfords remains undervalued. And it's in that position of becoming a momentum stock, which is unusual for stocks that used to be out of favor, if you like, and everyone's being centered on tech stocks for the past few years. They've been leading the stock markets higher, but there has been a rotation which has been going on for the past few months away from those leaders and into consumer cyclicals, of which Halfords is certainly one. So I think that is a good reason to buy in itself. It is part of the reflation play that is unfolding as we speak. Okay, let's have a look at some of the other data here. Price to book as well is not as good as we'd like, but it's not undervalued, let's say. It would have to be under 1 to be undervalued, but that's still reasonable. And price to sales, again, we'd be looking for a reading of 1, but again, it's at 0.56, so it's some way to go. However, its return on capital and return on equity are both very good. 11th out of 38 for return on capital in its industry, and 10th out of 38 for return on equity. It does have some debt. It has, I think, like 190 million revolving credit at the banks. But debt isn't necessarily a bad thing if it's been invested for a good reason. And I think that is the case when we're talking about Halfords. But because of that debt, it means its current ratio and quick ratio are in red here, these two red dots. We really want readings above 1 for both of those, in particular current ratio being how much the company can pay off its liabilities out of its assets, and the quick ratio being similar, but referring to cash and cash equivalents, how much cash it has on hand to cover its liabilities. So we want those to be above 1. So the reason for that, though, is because of its debt. But as I say, that debt is for a good reason. Okay, the market, the price for Halfords shifted gear earlier this month when it provided the market with a trading update, which was pretty impressive, and it follows on from a Q3 update, which was equally good for shareholders. So let's have a quick look at that. To date, the share price for Halfords is up 24%, and that's something like 6 times where it was at its nadir in March 2020, with the rest of the market obviously got hammered. But it's if you'd bought back then when it was at its bottom, it's gone up 6 times since then. So very much a momentum stock at the moment. Its Q3 like-for-like sales were 11.7%, and its update on the 1st of March, it is forecasting a 60% jump in annual profits. So profits are expected to come in around 90 to 100 million for that's pre-tax for the year. And what is driving those profits? What is driving that growth? And it's been all about bicycles. And since the lockdown started, what was it, a year ago now, isn't it? God, it's been a long time. But since then, Halfords has been in the enviable position as being designated by the UK government as being an essential service. That's to say, before the pandemic, the government was quite concerned to get people onto bicycles for the environment and climate change and so forth. And that has actually been pushed forward even more. So the government is putting money behind rolling out cycle lanes and making it easier for people to get on their bikes. And they introduced a scheme to help people go and pay for bicycles and for their servicing. So all of that has helped for growth in that part of the market. And Halfords is a market leader in the sale of bicycles, and not just the sale, but the servicing. And the servicing is important. They now have a scheme that you can join and pay so much a month to guarantee that you're going to get your bike serviced. So there's a recurring revenue stream there, and that revenue stream, I believe, is going to grow going forward. So the cycle division, like-for-like sales, grew 43% for the first 7 weeks of Q4, fiscal Q4, which is pretty impressive. And that also includes e-bikes and e-scooters. It's probably worth saying, because we're talking about like-for-like sales, it kind of says, it is what it says on the tin, like-for-like, but actually lots of companies define it in different ways. But fundamentally, like-for-like is meant to be comparing the same period and the same number of shops as compared to this year. But there are other things that could be taken into account or sometimes aren't taken into account. So it can vary somewhat. But anyway, so bear that in mind when we're talking about retail. And it also doesn't take into account the growth of online. So that's yet another problem. But anyway, for now, all analysts still like for like as a key metric, as opposed to previously used to be things like sales per square footage used to be the key metric. Those days seem to be behind us, and that's going to be a trend, I guess, because people will have seen, perhaps in their countries also, but the high streets, the malls and stuff are taking a bit of a hammering during this pandemic has increased that. Anyway, okay. And on that, quite presciently, perhaps, Halfords management made a decision a couple of years ago to start running down their estate, and last November announced that they were in fact going to implement a policy to reduce the estate, a number of shops, a number of garages, and so forth inside the company by 10%, and that equates to around 80 closures. So far they've closed 33, and that will help the bottom line to the tune of about 6 million a year. And equally important, it will also improve the margins. Now the margins on the auto centers is much better than it is on the cycles, although it's okay on the cycles also, but on the auto centers it will be further improved by the rollout of their mobile expert van initiative. So although they've been closing some sites, they've been building up a fleet of vehicles that go out to people and much cheaper to run. So that's also for the good and will help their figures. So the auto centers unit, where, as I say, the best margins are outside the company. Like-for-like sales in Q3 for the 13 weeks of Q3, this is data released in January, beginning of this year, was 21%, and that compared to year-to-date growth at that point in time of 6.6%. The reason I mention that is that it clearly shows an acceleration. Things are improving quite rapidly, and that is quite impressive given that in January, I think traffic on the roads was still 30% or thereabouts below where it used to be pre-pandemic. So they were still growing the business, despite the fact that actually people's cars were still sitting on their sitting on the roads more than they would have liked, I guess. So that's quite impressive. And to finish, in terms of the growth prospects, the company, as I said at the top, is investing, and it's investing in EV quite heavily, and that's reflected in expenditure on people. So on the bike side, they're going to increase the number of expert technicians inside their retail outfits that are servicing electric scooters, from 400 thereabouts at the moment up to 1,800. Also, in terms of electric vehicles on the car side, they're planning to increase the number of technicians by 100 to around 470, which means that every garage will have an EV expert. So this is defensive to some extent, and it's future-proofing the company, but it's also aggressive at the same time, because it's actually looking to the future and looking to carve out some of that pie for Halfords as people shift away from the petrol cars to renewable energy cars, to electric cars, and they're preparing for that shift in a big way. And obviously it hasn't gone on unnoticed. In the UK, the government has recently announced that by 2030, there'll be a ban on the sale of internal combustion engine vehicles in the UK. So Halfords is positioning itself for that future, an electric future. And I think that because of that, Halfords should be a buy. And the price target has been re-rated of recent times, so it's now at 382, which is let's find my trading view. Hang on, I'll show you the price. And as you can see, where are we now? 334 pence. So well below the price target. That's the median price target. So the high is 450, from about 20 analysts, I think, are covering the stock, and the low is 230. And I like to buy when the market's actually going down, and there's quite a few red candles here on the 4-hour chart here. And so let's put this onto the day. So we are looking, I think, at quite a good entry point. As you can see, the trend line is most definitely on the up. So that is our first pick for March 2021, Halfords. And let's move on to our second pick, Eurofin Scientific. And Eurofin is in the pharmaceutical and cosmetics testing space, and it is on a price to earnings ratio of 30. It's not too bad for medical and health. And it's also in the consumer, kind of overlaps with the consumer goods sector. It's somewhat cyclical to some extent. And what is its business? Well, as you can imagine, core business at the moment has been in COVID and COVID testing. And so it had a couple of weeks ago produced guidance which basically upped its forecast for next year and for 2023 also, which the market was very pleased by. Fourth quarter 2020 revenue was a beat at 1.7 billion euros. Not a massive beat, but nevertheless a beat all the same. Consensus was expected to be 1.68 billion. And 2021 earnings per share also beat, and beat quite impressively, from €3.61 versus the consensus of €3. And how is it doing this? I should also say the revenues have increased 19% for fiscal 2020. So how is it doing it? As I say, COVID is how it's doing it. And I would argue that the situation, not just in Europe, but in the world fundamentally, is one where we're going to need testing going forward for some time, if not forever. You know, COVID is not going to go away. So even if the vaccines are rolled out all over the world, even if that happens, there's still going to be a need for testing. And we haven't actually quite got there yet. So in Europe, and in particular France actually, vaccines are not rolling out that well. There's something like only 20% of people say they will take the AstraZeneca vaccine, for example. And in Europe, I won't go into all the details, but suffice to say, there's been problems with the rollout of the vaccine. In particular, the continent is dependent to a large extent in terms of what they've already purchased, forward purchases on AstraZeneca, but at the same time, they're telling citizens, actually, there might be a problem with the AstraZeneca. So that's going to stall the rollout, and that's going to stall the reopening of the economy. And actually, that's probably good news for Eurofin Scientific being a leader in PCR testing. And PCR testing, as opposed to lateral flow, is the gold standard for testing. And it's getting some momentum behind the stock, probably especially in France, actually, where Sanofi, it's one of its leading big pharma players, was in a partnership with GSK, with GlaxoSmithKline, but they're to develop a vaccine for COVID, but it failed. Its efficacy was very poor. And because of that, screen sharing is not visible. Oh, someone has just told me. That is a shame. I hope that gets fixed. Anyway, sorry. So where was I? Yeah. So yeah, Sanofi is a bit of a failure, but in Eurofin Scientific, France does have a leader. And so there has been momentum from European buyers, in particular from France. And I just wanted to look at a couple of drivers of the price going forward. Mpower Dx is a subsidiary of Eurofin, and it has just had its home kit PCR, so you can actually do this at home, which is quite impressive, approved for emergency use authorization in the United States. So there's another message about, hopefully some people did see the screen shares earlier on. I'll see if I can get that fixed whilst I'm talking, but probably not. Yes, so Mpower's product is now being sold by Amazon. So you can actually buy it on Amazon, and as I say, it's now into the United States. So that's going to be a driver of revenue for the company. Also, not so much talked about, I hope I can get this pronunciation correct, but they have a product in the PFAS space, which stands for polyfluoroalkyl substances, which is testing of water and impurities in water, potable and unpotable water. And people were talking a few years ago about the next world wars, if any such thing, calamity were to happen, may be over water and not over oil, because water is in quite short supply and we have an expanding urban population, and clean water is even shorter supply. Therefore, the testing of it will be increasingly important going forward. So the product from Eurofin Scientific is the only commercial product out in the market at the moment, and it is capable of testing for 75 compounds. So it's the most effective also. So that's quite impressive and will be a driver, I think, of revenues going forward, but also speaks to the leadership qualities of the stock in its space. And I'm going to try and share again. Hopefully you're going to be able to see this when I share it. Bear with me a moment. Please let me know in the chat if you can't see this screen share. Hopefully you can. So here we are, Eurofin Scientific. This is using the Financial Times, which relies on Refinitiv for its data. As we can see, that its earnings history since 2017 have been steady beats. In 2018, 2019, and 2020, they reported, as I mentioned, the 3.61 against the consensus of 2.61. The high of the high was 3.1. So that was a big beat. So they have good form there. Okay, there's a tendency from some companies to always under promise in order to create beats, but I think this is actually based on the reality of, in terms of the size of the 2020 beat, on the reality of the marketplace where they are actually building revenues on the back of the COVID testing. So that's quite impressive, and the growth rate of 35%. Please let me know if you didn't see that screen I just shared with you all. Okay, we continue. So Eurofin is currently priced at 79.29 when I was making my notes, and I think it will have some way to go. It's been re-rated on the back of its guidance and its forecasts for the next couple of years, but there's going to be further advances made, I believe, for this stock. And I'll just bring up the chart for you. And hopefully you can see that. And see the dip here, and just after earnings, and since then the market, the price has been rising and it's picking up some momentum, as you can see. So again, I think we are talking about a profitable entry at these current prices. So currently at 79.46. Stop that share. Hopefully everybody saw that. Please send through questions. Whilst I'm speaking, and we'll get to those in a moment. And so to come to my third pick, so I'd say Eurofin Scientific is a strong buy, and it has an element of cyclicality about it, consumer cyclical to some extent, but also it has a secular element, as I say, a long-lasting trend, which will break through economic cycles or continue through economic cycles, namely the fact that we're going to need quite a lot of testing going forward on vaccines and viruses. So I think Eurofin has been overlooked, and lots of money has been chasing the likes of Moderna and others. And yeah, Eurofin is one that's is kind of under the radar somewhat. So it's definitely worth a look. And our third selection is Ishares Russell 2000 Exchange Traded Fund. And why are we going for Russell? It's a down day on the markets, but I think the Russell is probably down less than the rest of the US markets. I'm not sure the situation in Europe is as I speak. And the reason for that is that the Russell is the smaller companies on the US market. So the Russell 2000 is the 2000 smallest companies by market cap in the Russell 3000 index. And the Russell's 3000 index represents, I think, something like 98% of the US stock market. So it's the bottom 2000 companies by market cap. So that means it has a very, very strong US focus. And because of that, if we want to get exposure to the upturn in the US economy, it's the place to be. The smaller companies are the ones that are going to win at the beginning of the economic cycle. And the US has a great depth in smaller companies. And I'll share the screen here again. Bear with me a moment. And it provides an element of diversification, quite a big element of diversification. So 20% of Russell 2000 is in healthcare, 16% in industrials, technology 14%, financial services 13%, consumer cyclical 13%, and others 22%. And it is 99% exposed to the United States, a tiny bit in Latin America, and an even smaller bit in developed Asia. And as I say, it's heavily diversified. So even though it does contain stocks that have seen some stellar growth, so for example, Plug Power, which has actually been in the news this week. I don't know if people saw that one about its accounts, an accounting error. I'll put that in inverted commas. The market didn't react to that very nicely. But anyway, a 1 year change of 1000%. So, you know, buying Russell, you are buying a bit of growth, but you're buying diversity, which is really important, I think, this year going forward. And you're also buying the reflation trade, the fact that the market is going to pick up because GDP is going to pick up. And there's Jerome Powell at the Fed was telling us yesterday, I think it was, they're forecasting a 6.5% increase for GDP. And the companies that will grab quite a lot of that in terms of profits will be the smaller companies to begin with at the beginning of the cycle. So I would get into the Russell 2000, and has a net expense ratio of just 0.19%. As you'd expect really with exchange traded fund, they tend to be quite cheap. And a good place to buy is on eToro. IWM is the ticker for the Ishares Russell 2000. Here we are. And it's only down 0.03% today. That's what the rest of the market is doing. I think the Nasdaq was down 1% last time I looked. So if you're looking for an element of safety, plus the possibilities of upsides, quite big upsides, then actually you couldn't do better than to put some money behind the Russell 2000. I was thinking of perhaps looking at the UK market, but it's not quite as sure a bet, I would argue, even though the UK market is actually a bit of a laggard and therefore is quite cheap. But anyway, maybe in another video we'll have a look at some of the smaller companies in the UK and elsewhere for that matter. Right, let me stop sharing there, and hopefully there's some questions that people might want to put to me. I don't see anything in at the moment. Is that because I'm not allowing you to do any chatting? Okay. I don't have any questions as yet. Maybe some technical issues at my side. But to recap, we like Halfords, a UK stock in the auto and cycle retail and services space. Eurofin Scientific, a French company, which is a market leader in testing in pharmaceuticals and also cosmetics, which we didn't talk that much about, which gives it the element of consumer cyclicality, which we like at the moment because of reflation. And by consumer cyclicals, we mean stocks that are more sensitive to the economic cycle. So as the economy expands, they will expand more quickly than larger cap and some other economic sectors. So yeah, we like it for those reasons. And it's proving to be a leader because of some of its technology, not just in COVID, but also in areas of growing importance, such as water testing. And finally, the Russell 2000, we are backing because we like the reflation trade, and in particular in the United States, where the third stimulus checks are landing, and that's going to juice the economy even more than it already is, perhaps. Although I believe some of the payroll data came in worse than expected in terms of unemployment or employment. But that's actually probably an argument as to why there's going to be more stimulus coming down the line, because the next tranche from of fiscal is to be aimed at infrastructure. Okay, so I'll leave it there, and happy trading. Have a look at eToro, where you can trade for 0% commission wherever you are in the world. And if you're in the UK, they also pay your stamp duty. You have a silly thing called stamp duty at 0.5% of your value of your trade. So that's quite a big win as well, that eToro provides. And I gather eToro is doing a IPO, a SPAC, special purpose acquisition company they're merging with. That news came out this week. So they'll be going public soon, so we might have them on our list, because they seem to be have a hell of a lot more customers than Robinhood, but a valuation that is a tenth the size of Robinhood. So that could be one to look out for in a future program. So thanks for watching, everybody, and excuse me about the technical issues. I hope you saw the screen shares, at least some of them, and this broadcast will go out on YouTube also, but not live, as we were meant to be able to do it live, but I haven't been able to get the connection to YouTube working, but we have it recorded so we can get it up there in edited form. And last chance on any questions. If anyone would like to ask me. Any takers? No. Ah. Okay. King K. Thanks. What do you think about BP? Ah, right. Okay, we've got some questions. I used to rate BP on the fact that it seemed to be more attuned to diversifying away from oil and into renewables. And I think they probably are still among the majors, the ones most attuned to that, but I think others are catching up with them. So I think Exxon, for example, was it last month, talked, I'm not sure what they're doing, but they talked about moving into renewables. So I think that's going to be an interesting side to the oil companies. Everyone's talking about dirty oil, or they were, but I think they know the sensible ones amongst the leadership of the oil companies realize that oil's not going to be here forever, and actually it can't be. I don't know, depending on what your attitude is to climate change, I think it's real. And I think that means that we do need to move to renewables, and the more sensible among the oil majors are preparing for that. So I think BP is probably at the forefront of trying to do that diversification. So maybe not BP specifically, but maybe an oil ETF, just for an energy play, because just on the reflation trade, although I think oil is down 4% today, that's on the back of Europe being such a mess and slowing down the reopening of Europe. So that's going to slow down demand pickup for oil. But leaving that aside and assuming Europe gets its act together a bit better, I think the reflation trade is probably still intact, and that means what oil demand will increase, I just should imagine. So an oil stock would be good, an oil ETF. Could you give again the name of the first interesting trade? That was Halfords, which is a UK company, which is in the bicycle and auto space, and it sells bicycles, but also sells accessories and parts for cars and technology for cars, like speaker systems and so on, and also has garages. And it's investing quite heavily in electric vehicles in terms of the servicing of them. And because of its market position, it's in a leadership position, I think, and is investing quite heavily in manpower, in people, in qualified technicians on both the electric vehicle side and also for electric scooters and electric bikes. And I think the micro mobility, I didn't talk that much about it, but I think that is a micro trend, if you like. And there are different ways to try and get in on that trend. So you could just go and buy the people making the e-scooters and e-bikes. You could get in on the people doing the hiring. So, you know, the stuff that, I don't know what city you're in, but there might be a company doing hiring. I think there's some American ones called Line, for example, and there's some big ones in Asia as well. That might be one way to go. Although I think the unit economics of just similar to the bike mania that there was for hiring bikes, and when they all ended up littered all over China, and there's big huge dumps of these bikes in various parts of the world that never got used. That could be a danger, I think, in terms of going down that route with scooters, e-scooters. The unit economics of that model might not necessarily be profitable. So another way of doing it is to actually check the retailers and the servicing and the recurring fees, because bikes. From what I've seen and some individuals that I know, they do break down, the electric ones, and they're not as easy to fix as a mechanical bike. So, or a mechanical scooter, which is just relying on your pushing power as opposed to an electric motor. So that is the recurring stream. So they're investing, Halfords are investing in that also. So they're going to employ something like 1,800 technicians to do that servicing. So that's another revenue stream. So Halfords was our main pick. And it's up about 6 times since March 2020. So bear that in mind. But it does have momentum, and it does have an expanding market and a moat of sorts, not a massively wide moat, to borrow from Warren Buffett in terms of being able to defend its position, but because it is a market leader and it does have quite an expansive network, it puts it in quite a strong position to defend its market and to expand its market. And do we have any other questions? BP? No. Time for some more before Zoom cuts us off, people. How to find, learn to trade. Hopefully everyone's trading profitably. Let's see any more. I think I come up as Scott. Someone saying, thanks, Scott. It's Gary, as it goes, Gary McFarlane. And Scott is a colleague of mine who actually part owns, I think, this site. Okay, well, I don't see any more questions. So thanks for your time, everybody. I hope you found that useful, and this will be part of a regular webinar session. And hopefully we will get a bit better with the technology, and we'll get a few more questions coming in also. So very last chance. It'd be great to hear from people from around the world, how your economy is doing, what opportunities there are you'd like to share with anyone. Maybe for next time. Okay, well, thanks for watching, everybody, and I'll bring proceedings to a halt.